everyone, and welcome to our 7 Investing podcast, where it's our mission to empower you to invest in your future. I'm 7 Investing founder and CEO Simon Erickson. We're going to be chatting about the macroeconomic picture today. Got a big announcement from the Fed that we're going to dig into. We'll chat about inflation. We'll talk about interest rates. We'll talk about what all this will mean for you as an investor in the stock market. But who better to talk about the macro? There's no better investor out there to chat with when it comes to macroeconomic events going on than Puru Saxena. Puru is an individual investor now. He's a retired money manager. I think he's just got a great kind of pulse on what's going on, reads the tea leaves very well. He's going to chat a little bit about what he's looking at in the macroeconomic picture. Puru, it's always a pleasure having you on our 7 Investing podcast. Thanks for joining me.
My pleasure, Simon. Always great to have a chat with you.
Yeah, Puru, we'll dig into a lot of those, right? We're going to dig into interest rates. We have a lot to talk about, whether it comes to inflation and growth style investing and valuations. But maybe let's start at the 10,000 foot level, right? Just today, we're recording this on Thursday afternoon in the US, Friday morning if you're in Hong Kong. But just today, we got an announcement from the Fed that Jerome Powell stated that they're going to be expecting to raise interest rates by 50 basis points, so half a percentage point. A lot of people responded very positively to this. The market certainly loved it because some were expecting a much larger rate increase than that. Of course, the Fed is very interested in controlling inflation and the economy. But 10,000 foot level, Puru, what did you make of the Fed's announcement earlier today? And maybe even more broadly than that, what's the state of the American economy right now?
Well, Simon, the economy is slowing down pretty rapidly because monetary policy liquidity drives the business cycle both on the way up and the way down. We had huge amounts of stimulus, both monetary and fiscal, into 2020 in response to COVID and the lockdowns. And basically that caused a massive boom, both in the economy as well as the financial markets. As you know, stocks went up 4x, 5x, 6x, 7x in a year, and they were basically a huge bubble. And then the Fed started, coming after inflation. It signaled last autumn that this inflation was no longer transitory, that they were behind the curve, and that they were going to reverse policy pretty abruptly to try and bring down inflation. So that caused the reverse to happen. We had the boom, and then we had the contraction, the post-bubble contraction, which has been playing out in the markets for the last 5 or 6 months, maybe a year in the case of the SPACs and the most risky segments of the market. They peaked in Feb last year. So the carnage has been going on for about 12 to 15 months. So my view is that, the economy is slowing down pretty sharply. I suspect that the PMIs in the US will come down to maybe 51, 52, maybe 53, around that sort of level. So there will be an impact on the economy because of the Fed's policy shift. And the financial markets, as you know, have been discounting this for the last 5 or 6 months. The indices topped in November. So now we are sort of 5-6 months into the sell-off. It has been pretty gruesome and brutal if you are an investor in anything which is basically long duration, especially growth stocks. The Nasdaq is down. A lot of the Nasdaq stocks are down a lot, 50, 60, 70%. Some of the growth stocks are down 70 or 80%. So the market has already been discounting the Fed's policy shift and also the slowdown in the economy. And I think that the growth stocks are pretty much washed out here. A number of the high quality growth stocks did not break their March lows during the recent bout of selling, which just concluded yesterday, your time. So I suspect that we are going to get, at the very least, a sharp counter trend rally, a relief rally in stocks over the next few weeks, perhaps at least over the next 10 days to 2 weeks or so. My view is that the growth stocks, the risk reward is very, very favorable if you have a 2 or 3 year time frame, because I think that because of the carnage over the last year or so, Simon, they are down 70 or 80%, and the valuations have become pretty reasonable for the vast majority of these companies. And my feeling is that the CPI is going to roll over. So the inflation, which everyone's worrying about, is probably peaking now, and it will roll over because of what the Fed is doing. And monetary policy always works, but with a lag. So I suspect that inflation is going to roll over, and long-term bond yields are also, in my opinion, pretty close to an important peak. And when the economy basically decelerates, inflation rolls over, I think bond yields, the long-term bond yields are also going to start sliding. And that's going to be good news for the long duration secular growth stocks, because when the economy is weak and the rest of the businesses are struggling, the cyclicals are struggling, commodities are coming under pressure, then the secular growth stories, which are not really dependent upon the economy, become attractive for investment dollars. And I think we're going to start to see that shift, pretty much the reverse of what has happened over the last 5 or 6 months. I think the beaten down growth stocks are likely to outperform over the next 12 months or so. And the stuff which is already currently bid up, the defensive, the dividend stocks, the energy, commodities, and so forth, I think they are more vulnerable at this point because they've had such a sharp rally.
There's a lot to unpack there, Puru. Let's focus on the growth style investing that you just mentioned, because I'm really interested in that as well, as the type of investor that I am. But we've seen the money's been very cheap, right? Since the great financial crisis, 2008, interest rates were very low. So a lot of companies put their foot on the accelerator. It didn't really matter if you were burning cash or cash flow negative, because you could always raise money either at a very low interest rate or just issue stock, equity when your stock price is very, very high. We've seen that contract, like you mentioned, from the last 6 months. The indices hit the top in November. We've seen a sharp correction, bear market for the Nasdaq even. And as you mentioned, several of those companies down even 50 or 70% from their highs. And again, you mentioned that you think that a lot of that pain might already be baked in with the valuations. But do you think that growth style investing still continues in this same form that we've seen for the last, call it, 12 or 13 years, where money is cheap, and that was kind of the okay for managers to be a little bit more aggressive? Or do you think that kind of these companies that have their cash flows in the future, do they rein it in a little bit more, and kind of profitability and cash flows are a little bit more important now?
Well, Simon, this is an interesting thing, because every time growth stocks go down, the value crowd comes back and says, we told you so. But the time to be negative towards growth was not now. It was last year, when they had gone up 5 or 6 times in a year, when I was cautioning people that this was a bubble and this was going to basically cause problems when the Fed reversed course. I used to get, a lot of hate comments saying, you're an old fart, you're an old geezer, you don't know what you're talking about. This is the new paradigm, digital transformation, and all the buzzwords which are typically associated with the raging mania. That was the time to be defensive and cautious growth, because obviously, after a 70 or 80% drawdown, it's going to take a long time for those people to basically get their capital back, perhaps 3 or 4 years. So that was the time where the risk reward was extremely unfavorable for growth stocks. But, if you are looking today, we've already had a 70 or 80% drawdown in the vast majority of the growth companies. Some are down 50, 60%. The best quality names are down 50 or 60%. Now, if you look at what happened in the TMT bubble, which is the telecom media technology bubble, when the bubble popped in 2000 and 2002, early 2003. So that was basically a 3-year bear market. And in that bear market, most of the tech stocks, Simon, went down maybe 70 or 80%. And those investors who ignored the negative headlines and the negative sentiment, and they were brave enough to invest after 70, 80% washouts in those companies, in the good ones, they made an absolute fortune over the next 10, 15, 20 years. And I think something similar will play out now. I don't think all the companies are going to reward shareholders. There are rubbish ones. They're not going to come back. A lot of these companies are never going back to their all-time highs. But if you invest in the really good ones, where the cash flows are strong and the margins are trending in the right direction, the leadership is strong, the revenues are strong, and the market positioning is strong, there's not much competition. Those businesses should be within, at the new all-time highs within 4 or 5 years, I would imagine. I don't think that this is the end of the road for the really good companies. So the really extraordinary businesses, they will be back to new highs, in 5 years, 4 or 5 years from now. And that may seem like a long time, but if you think about it, if something was at 100, it's now at 30. To get to 100, is basically you're getting what, a 300% return. From 3, you're basically tripling your money from 300 or 30 to 100. You triple your money. And basically, if you do that in 4 or 5 years, that's a pretty decent IRR, isn't it? So I think those investors who ignore the bearish chatter and are intelligently investing in these great companies at these distressed prices are going to do very well. Now, I'm not smart enough to tell you what these stocks are going to do next week or next month. They may come off a little bit more, but I do know that if you are buying these companies at these reasonable valuations, I think investors are going to generate a very healthy IRR over the next several years.
Yeah, it makes a lot of sense, Puru. For years before, it seems like such a long time ago, but before COVID, there was already this digital transformation that was underway. That was kind of the buzzword that was sticking for anyone who is a tech investor, anyone who's a growth style investor. Then COVID happens and everything has to happen online. So it seems like that and the low interest rates just accelerated a lot of this. We forget it at the time now because we've seen the contraction in so many of these stock prices, but there was such a pop in the tech companies just over a short period of time there that's now back to normal. It's kind of interesting to see that working out the other way. I want to touch on interest rates in a minute here, but let's get back to inflation just a second, because you mentioned margins and profitability and cash flows. The CPI was up 8.5% in April. That's the highest rate of increase that it's seen in 40 years since December of 1981. And yet unemployment's still at 3.6%, right? It's a low unemployment. So the economy is clipping right along very, very quickly. And that's why we think the Fed is doing what it's doing. But, do you think, what parts of the economy do you think are most sensitive to inflation? I know that energy has been one of the largest contributors to that top line inflation number. And so if you have ships, and logistics going across the globe, of course, you're going to be exposed to that. Maybe software companies not as much, but what's your take on inflation? Who's winners or who's losers from inflation? Or do you really just not worry about this as so much as an investor?
Well, if you are going to play the macro game of jumping in and out of different sectors and industries, it's a very difficult game to play. I don't know anybody who gets it right consistently, so I don't bother. But if coming back to your question, I think the companies or the industries which benefit from rising commodity prices and these bottlenecks we've seen in the supply chains, those have been the big beneficiaries from this inflation and also this money printing. The companies, which can't have sort of pricing power and which are dependent on discretionary spending from consumers, they're the ones which basically end up feeling the pain because consumers don't have as much money to spend because their purchasing power has diminished when you have monetary inflation and prices go up. So coming back to your question, I believe that inflation is peaking and inflation will gradually come off for the rest of the year. And in this scenario, I suspect that commodity prices are most vulnerable, especially if you have a deceleration in the economy. Then I think commodity prices are going to come off over the next few weeks, few months, and the commodity producers, energy and all these miners and so forth, which have done really well over the last 6 to 8 months, are likely to come under some severe pressure. The beaten down stuff, which was knocked down pretty hard, the long duration growth stocks, I believe now are very reasonably valued, and they are currently offering a pretty decent medium to long-term IRR potential for investors. For my part, Simon, I don't play the jumping from industry to industry game because it's very difficult. It's very difficult to know when to come in and get out into certain things. So for me, I've just been holding shares of these long-term growth stocks, the software companies, the e-commerce companies, online payments and so forth, where the management teams are brilliant, the revenue growth is strong, the operating results are strong, and the valuations are now pretty low. So I suspect, over the next 4 or 5 years, I'd be very surprised if I don't generate at least a 20% IRR on my investments, which would probably triple my portfolio over the next 5 years or so. And that would be pretty decent return. I don't think the S&P is going to triple in the next 5 years, or the energy companies. They've already had their day in the sun, and I think they're due for a pullback.
It really is true, Puru. I certainly agree with you. It's tough to jump in and out. It's not that long ago that we remember, gas tankers, oil and gas tankers sitting. They can't just be taken because they can't sell the oil, in the harbors. And then here we have energy was the best performing sector of the S&P last year, up 55%, which is kind of incredible, especially with as strong of a market as we had. Let's touch on interest rates again. This is, something you said was that monetary policy is what creates booms and busts. And this has been the case for 100 years. I love that quote, certainly true. The 10-year treasury is now at about 3%, but it's risen very, very quickly. It's up 100 basis points in just the last 3 months. And the 2-year treasury is at 2.6% now. That's up 130 basis points in the last 3 months. But there's something interesting that happened on April 1st, just about a month ago, Puru, which is that we saw an inversion of the yield curve. It's normal where the 10-year treasury has got a higher rate of return than the 2-year treasury, but that was flipped on April 1st, where the shorter term duration bonds had higher interest rates than the longer terms. And we call that the inversion of the yield curve. That's only happened, to show how rare this is, that's only happened 4 times in the last 25 years. And in each of those previous instances, which were in 2019, 2005, 1998, and 1988, there was a recession that followed after that. It's almost a predictor of recession, at least in the U.S. economy, at least in the near future, in the near past. Can you talk about kind of, if you follow the inversion of the yield curve, why that's so significant? And do you think this is predictive of an upcoming recession in the U.S. economy?
Simon, I do follow the yield curve. I have done for the last 15 years or so. But the yield curve has not yet flashed a valid inversion signal, because if you go back into history and then you see these periods which you mentioned, which is the inversion, which is where the short-term interest rates are temporarily higher than the long-term bond yields, you will note that only in those instances where the inversion was persistent did we actually get a recession afterwards, and not immediately. In some cases it took 12 to 15 months after, or maybe 18 months after in some cases, before the economy slipped into a recession. This time around, we only had an inversion which lasted maybe 1 or 2 days. And that, in my opinion, is a fake false signal. It's a head fake, in basketball terms, which means that it's not really a valid signal. And also, if you look at the 3-month and the 10-year spread, which is the spread between the 10-year treasury yield and the 3-month treasuries, that has never inverted at all during this cycle. Only the 2-year inverted. And then as soon as the inversion happened, what did the Fed do? The Fed sent out, Bullard and a few other hawks, and they started talking about quantitative tightening. And that's what caused long-term bond yields to really take off over the last month or so. So they effectively steepened the yield curve, the Fed, on purpose to avoid the recession threat. And all this jawboning by the Fed officials over the last month or so was done purposely to steepen the curve, and they've managed to do that. So at the moment, the yield curve hasn't yet flashed an economic recession signal. I usually look at a persistent inversion which lasts for about 60 to 90 days. We haven't had that yet. If we do get that at some point this year, then that would be a signal that a recession is coming, perhaps in 2023 or early 24, but we're not there yet.
That's a great point, Puru. And before I scare everybody off and they turn off this podcast and start loading up on ammunition and beef jerky and head for the hills, even a recession, it might not be doom and gloom for the stock market. The stock market is kind of predictive of the future state of the economy. Stocks fall first before even recessions take place. In fact, there's some interesting research from LPL Research here that says that even in those 4 previous inversions, which, as you mentioned, Puru, this only happened for a couple of days, not a prolonged period like you mentioned, but even in the 4 instances before this, the S&P gained an average of 29% from its low, even through the recession, over the next average 17 months. So the stock market tends to be predictive of things like this. Even as the economy is struggling, it seems like a lot of that is already baked into the expectations, especially for pessimistic expectations.
For sure. I mean, the stock market looks ahead. The stock market tops when the best has been discounted, and it bottoms when the worst has been discounted. So the news trails the financial markets. The news is always rosy and wonderful at the top of the cycle. When, the economy is strong, stocks are at record prices, corporate earnings are very strong, that is when equities peak, and conversely, stocks bottom when the worst has been discounted, and the stocks bottom when the news is absolutely scary and frightening and dire. And that's when stocks tend to bottom. They don't bottom when things have improved, because by then prices are 20 or 30% higher, or 40% higher in some cases. So I don't really have a firm view at the moment as to whether the US economy will go into recession or not. If somebody put a gun to my head and asked me, I would probably say, I don't think we are going to see a major recession this year. And I don't think that this is similar to the 2008-2009 cycle, because that was a horrendous banking crisis, a housing bust, which caused almost all the banks to go under in the US and indeed in most of the developed countries. We don't have similar excesses right now. We've had excesses in the equity market, which have largely been corrected now with the 70 or 80% declines in the growth stocks, and the valuations are now back to the historical averages. For the growth stocks, at least, the S&P and the Nasdaq are still mildly elevated, maybe 10% or so, but the equity risk premium hasn't really blown out yet. The equity risk premium is still pretty sort of low, and as long as that is the case, who knows, we may get another 7 or 10% downside in the indices. But I don't think we're going to see a 40-50% crack from here, simply because the S&P is now trading at sort of 17.5 times year-end earnings, and the Nasdaq came off to around 2021. So we may get some more additional selling, Simon. Nobody really has a crystal ball, but I think, especially for the growth stocks, I think most of the carnage is now in the rearview mirror, and this is the time to go shopping, not to panic. In my opinion, I could be wrong, of course.
Yeah, great points. Let's chat a little bit about those historic valuations, right? Because it was, I guess it was a little more than a decade ago now that, Bill Gurley, a very famous venture capitalist out in Silicon Valley, pins his now famous blog about the 10x revenue club, right? He was seeing that, it was aggressive that some companies out there, this is again, a couple of years removed from the dot-com burst, were now selling at 10 times sales, Puru. And he applauded companies like Netflix that were going out there and creating subscription models that weren't so much based on transactions or advertising. Of course, we just blew that one out of the water. We saw Zoom video communications, selling at 40 times sales not that long ago. And it seems like a lot of the market got really, really excited. Of course, it's not just subscription models, but it's more recurring revenue. It is subscriptions, but a lot of it's locking in larger enterprises with cloud-based solutions that are at very, very high margins. But the nature of my question here, Puru, is do you have kind of a rule of thumb or a way that you think about what a realistic valuation is for tech companies? Is there a rule of thumb, whether it's price to sales multiples, EV to EBITDA, anything even unrelated to those? But how do you think about what's a good valuation to pay for a big tech company?
Well, it depends, Simon, whether the company is profitable or not. And I know at the moment, everybody hates unprofitable companies, simply because everyone wants to see profits now. And I think that is a mistake, because those companies which are reinvesting in their business aggressively to try and grow and capture as many customers and market share as they can, in my opinion, they're doing the right thing, and they may not be immediately profitable, but a lot of these companies can be profitable tomorrow if they want to. They're unprofitable by design. They spend a vast majority of their revenues and cash flows in spending S&M, sales and marketing, to try and grab as many customers as they possibly can, because all these customers then keep, sending in them checks month after month, quarter after quarter, because of the subscription models. So in my opinion, at least, they're doing the right thing. I don't think they should be slowing down just because shareholders have decided suddenly that immediate near-term profitability is more important than the long-term target. So coming back to your question, I think for the profitable companies, I look at the EPS growth of the company. I look at the earnings per share and the growth rate, and then I look at the valuation based on an earnings multiple, or I look at free cash flow. Those companies which are investing heavily and they don't currently have any sort of free cash flows or profitability, I look at the sales multiple, the earnings EV to revenue multiple, and compare that with the past over the next sort of last 5 years or so, what the average has been. And then I try and assess what these companies will be earning in their revenues and cash flows 4 or 5 years into the future. And then I apply a reasonable multiple on that number to try and see what the market cap will look like 4 or 5 years from now versus where it is today. And then I calculate, what the IRR would be. So if the market cap, according to my calculations, is likely to be double from where it is today 5 years from now, that equates to a 15% return for me as a shareholder, give or take a share dilution. So these are some of the rough numbers that are calculated. Of course, there is no perfect science in this. You have to, use your own judgment based on what has happened and, history and everything else. But these are the sort of metrics I look at. And obviously a major component of that also is the competitive position in the business, because a lot of these companies promise a lot, but then, you have competition, something comes along and then they can't meet those numbers. So I think competitive positioning, as Warren Buffett calls moat, is very important when you're investing in long duration assets, which are growth companies, because obviously if those numbers don't materialize, then the stock gets clobbered. As we have seen recently, they go down 30-40% in one single day. So, it's not for the faint of heart, and it's not very advisable to invest all your portfolio in maybe 5 or 7 companies, which a lot of people seem to do. I think that's too risky. Research has shown that if you have a portfolio of around 20 companies, it gives you all the diversification that you need vis-a-vis an index. And if you go any more than 22 companies, then that only waters down your returns. So that is diversification, WORSI, diversification. So for me, I tend to focus in the sweet spot about 18 to 20 companies, and some of them don't work out, but position sizing is pretty small. So even if I, take a hit on a couple of them, it doesn't really affect my total portfolio very much.
I like the approach to growth style investing, Puru, looking kind of at the larger market and then kind of back calculating out your IRR. Just to add something to it, I'm also a big fan of innovation, of growth style investing too. And my perspective on this is there's such scalability in a lot of these models that are digital, that are doing business on the internet, that are software companies. It's totally fine that some companies out there are the Walmarts or the Chipotles or the Starbuckses that just grows linearly. And any Wall Street analyst that's worth his salt is going to be able to predict those and kind of follow along with the multiple that would make sense for those companies. But the scalability, the S curves we always talk about, the disruptive innovators that are out there, they can grow very, very quickly in ways that nobody was expecting. And a lot of times those price targets are trying to just keep up with a company that's knocking out of the park. Certainly we've seen that with Tesla, blowing past expectations in recent years. Certainly doable in tech as well, as you have very scalable software models. So I love this approach. I wanted to chat a little bit about the larger technology companies, right? We've seen so many of the gains of the S&P 500 of this past decade coming from its largest constituents, which are now technology companies, right? The FANG companies, Facebook, Amazon, Apple, Netflix, and Google. And a couple of those in there have changed names recently, but it's the same big tech companies, right, that have just done phenomenally well in these last 10 years. But we're starting to see a divergence, right? They're not all going, lockstep up together. Facebook and Amazon have certainly, and Netflix have certainly been struggling, at least in this last year or so, while Google has been doing just fine, and Apple seems to be doing just fine too. What's your take on big tech companies? What do you think about the FANG companies? Is this divergence going to continue? Or are they going to still be the best performers for the next 10 years?
Well, I think there's going to be divergence, Simon, simply because, over the last 15 years or so, or 20 years now, when the internet really took off, a lot of these businesses basically became possible because of the internet. The Googles of this world, Facebook's social media, you had the smartphone, which was made possible because of the internet, and Netflix, which is also streaming, Amazon, which was made possible because of the internet, e-commerce. So these businesses basically were the leaders, and they developed their own categories, if you will. And they grew and they grew and they grew and they grew because they were virtually like monopolies, global monopolies or duopolies. And they were able to grow rapidly for a number of years. But the problem is after, growing so much for the last 20 years or so, they've become really big. That is the problem. I mean, scale is a problem, eventually becomes a problem for everybody. So if you have, a 50 billion revenue run rate, you're not going to grow at 30% a year. And there is only so much market you can capture. And even if you, come up with a new business line or two, in the beginning, that business line is not going to even move the needle because your other core business is going to be so large. And I think that's what we are seeing today in the FANG stocks. I think they are past their prime. They're no longer the secular growth stocks they were 10, 15, or even 5 years ago because they've become so large. And you can see that from the growth rates. The growth rates are now down. The FANGs are growing at maybe 15, 20% a year, revenue growth, if they're lucky. And I think the baton has been passed on already to the next generation of these growth secular compounders. I don't think the FANGs are going to be the market leaders going forward over the next 10 years or so. I think the new generation of growth companies are going to power the indices forward. And coming back to your question about only a handful of companies being responsible for the vast majority of the gains in the indices, well, this has been the case for 100 years. Research has shown that over the last 100 years, only 4 or 5% of the stocks have actually powered the vast majority of the growth or the gains in the indices, which is a remarkable figure when you think of it. So 96% of the companies in the indices over the last 100 years haven't done anything for the growth, for the gains from the indices. And only the select handful of great companies at that time have basically been responsible for the vast majority of the growth or the gains in the indices over the past century. So, I mean, in that regard, this is nothing new. As investors, our job has to be to try and identify the very best companies which will be able to grow and grow and grow over the next 5 to 10 years. And that's where you'll make your money. And, growth investing to me, is the most logical way of investing, simply because once you identify a great company, and if you basically get in at a reasonable price, you don't have to do much. You can just be a shareholder of that company for the next 8 to 10 years. And as long as the company is executing and there is no competition, and the competition is being kept at bay by some characteristics of that business, then you can pretty much make a pretty good return as a shareholder. And if you divert into value investing or playing, the timing game, then the game becomes harder, in my opinion, because if you are, looking at investing in, say, cheap, beaten down stocks, i.e. commodities when they're low, or other cyclicals, or the value stocks which become very cheap from time to time, then you cannot buy and just hold those for the next 5 or 7 or 8 years, because at some point their valuation will come back to normal. And that's it. They can't grow anymore because there is no underlying growth in the business. And then you have to, sell them and look for the other bargains. So it is a much more active game, and it's a lot harder, in my opinion, at least, than investing in, say, 20 world-class companies, which are going to grow and grow and grow over the next 5 to 7, 10 years. And that game is a lot harder. And if you look at, the past performance going back 40, 50 years, the biggest winners in the stock market have been those companies which have been able to grow rapidly for long periods of time, whether it's McDonald's, Starbucks, Home Depot, Walmart. I'm not even talking about tech companies, Nike, any business, Monster Beverage. So the biggest companies have been those which have actually been able to grow and grow and grow for a very long period of time. Tesla. So, this thing that, people think, tech investing is growth investing, I think is a misnomer. The reality is that, if you invest in any solid business, which will, capture a lot of the market share 5, 10 years out, it doesn't really matter which industry it is in. As long as, there is growth, there is profitability and free cash flow. That's what investors, worry about. And it just happens to be that, these leaders in the tech space are able to, grow and compound with very little capital requirements. And that's what attracts me to these companies. If you invest in, a car company or any other industry, then you have to spend a lot of capital generally to be able to grow. Whereas if you are a software business or an e-commerce business or an online payments business, then your capital requirements are a lot lower. And every new customer basically adds directly to your revenue and cash flows and bottom line. That's what I like about these companies. So I think nothing has changed in the investment world, even over the next 10 years. Those shareholders who invest in these strong growth stories, these businesses which are likely to be a lot bigger 10 years from now, if they get in at a reasonable valuation, they will make money hand over fist. And this has been the case for the last 100 years.
Let's chat about some of those growth stories, maybe some that are a little less familiar than the FANG companies that everybody's seeing a zillion headlines written about. We had a question come in from Twitter that actually mentioned that you've been chatting recently about Quantumscape. Ticker on that is QS, and then also another company, New Holdings, which is a digital bank. NU is a ticker on that one. That's a digital bank that has a presence in South America. Those are less familiar names, Puru, for a lot of people, but would you like to chat about either of those companies or perhaps any other company that's a little bit smaller, a little bit less familiar that has your attention right now?
Yeah, sure. I mean, we can briefly discuss both if you like. Quantumscape is my play on clean energy and also EVs. Quantumscape is developing a solid-state lithium battery. The company's management team, is pretty switched on. They're all Stanford graduates. The company is, well funded in terms of shareholders. They've got pretty prominent shareholders, which basically own shares in the business. And they have been putting out data over the last 12 or 18 months or so, where they have shown that they have got the technology. And now it's only a question of scaling up this technology and building bigger battery packs, which can be used in cars. Volkswagen owns, I think, about 10% of the company. And they have already signed an agreement whereby they have the right of first refusal or the first claim on these batteries whenever they come into commercial production a few years down the road. This is a speculative investment. It's pre-revenue. They don't have a workable cell right now. The technology has to be commercialized and scaled. So, this is one of my speculative, riskier investments. But, given the carnage we've seen in the stock over the last 12 months or so, 15 months or so, I think that if they do pull it off, then this is likely to be a very sizable business 10 years from now. I wouldn't be surprised if this stock becomes a 10-bagger over the next 10 years if they get the technology to market and if they can scale. And I actually did some due diligence on this before investing, and I heard some comments from the inventor of lithium-ion batteries. I can't remember his name. He's a British guy. He won the Nobel Prize a few years ago. And he himself acknowledged that the data he has seen from Quantumscape is by far the best data he has ever seen in solid state. And he thinks that this technology is viable. And then it's only a question of time before Quantumscape can actually commercially manufacture this at scale and power, hopefully, a lot of the car companies, which are going to be coming out with EVs, over the next few years. And they're also going to get into battery energy storage. So they are going to provide batteries for energy storage for utilities, which is going to be a pretty big business. So, the car companies are exciting, Teslas and stuff. If you are a shareholder in this, you've done very well. But my concern with Tesla is that there is so much competition now coming online with EVs. Mercedes, Porsche, all the German companies are coming with pretty spectacular models. And Tesla, has been the clear leader, and I don't think its lead will be disrupted over the next 5 to 10 years, simply because when people think of EVs, they think of Tesla, just like people used to think of Apple when they thought of smartphones. But, auto manufacturing, auto OEM is inherently a high capex, traditionally a cyclical business model with a lot of competition. And I think if you invest in Quantumscape or a battery maker, for example, then that battery maker is effectively going to be providing the picks and shovels for the EV race. So whoever wants that battery will have to come to them and get one. So I think, according to me anyway, that I think this is a safer way of playing this space because it's not subject to competition. If they do crack this solid-state lithium battery technology, then they will have patents and stuff. They will be protected. It's not going to be very easy for competitors to replicate what they're doing. But again, as I caution you again, this is a pre-revenue speculative investment. It was only about 3% of my total portfolio. So if it goes wrong, it's not going to kill me financially. And coming back to the other one,
a really good board of directors too, by the way, on Quantumscape. Jamie Schroebel from Tesla, one of the co-founders of Tesla. John Doerr has some influence on that. Really strong to see such a strong leadership team. Yeah, it's pretty good. The corporate governance seems to be pretty strong. Board of directors are strong. The shareholder list is pretty impressive. So they seem to have the potential to be able to deliver these batteries in 2 or 3 years down the road. And if they do succeed, then I think, the stock's going to be up 5-10x over the next 10 years, which is why I've invested in this. And if they do succeed, I think, Simon, in the next 10 years, they will still be growing at a very rapid clip. So I think this is likely to be a 10-15-year investment for me, at least 10 years. And I think this is a pretty decent way of investing in this energy clean energy battery sort of space. Turning to your other company you mentioned, New Holdings. This is a
Latin American digital bank. So they are now competing with the big legacy banks in Latin America. And the company was set up by a Colombian guy who's pretty impressive resume. He used to work for Sequoia, and he is Colombian. And the company actually works at the moment, operates in Brazil and a couple of other countries. And they are also now offering a lot of solutions to their customers in Latin America, you know, from banking to credit to investing and everything else. So it's basically trying to be a one-stop shop, an app for all the financial needs for their customers. And because it is a digital bank, they don't have any branches. Their costs are lower, so they are able to, you know, offer better rates, interest rates, and so forth to their customers on deposits. They are able to offer advantages, and the revenue growth rate is fantastic. If you look at the revenue growth rate of this business over the last 1 or 2 years, is very, very strong. And even the analyst estimates for this business going out 4 or 5 years are pretty remarkable. Wall Street analysts expect that this company will be compounding its revenues at 30-40% 4 or 5 years out, which is pretty remarkable. And after this washout we have seen in the growth stocks, I felt that the valuation had become pretty reasonable. You know, it's not reasonable if you compare it with the likes of a JP Morgan or, you know, Bank of America, because they don't have any growth. But if you look at the growth trajectory and what they're going after, I think this has the potential of being a pretty good winner over the next 4 to 5 years at least, if they are able to execute, which the numbers seem to suggest that they are succeeding.
Latin America is very quickly getting connected to high-speed internet. And like you said, a digital bank is a natural winner from that. I wanted to ask you about Mercado Libre, which is one of the e-commerce providers in South America, Latin America, really. It's one of the leaders, mostly doing business in Brazil, Argentina, and Mexico. Puru, I think that you have a love-hate relationship with this company. It's either, you know, it's one of your larger positions, or you kind of changed your opinion about it recently here. How do you feel about Mercado Libre, and what do you think about their niche that they're carving out in Latin America right now?
Well, Simon, I first invested in Mercado Libre over 10 years ago, you know, around 10, 11 years ago, and I've been a shareholder, and up until recently it was one of my bigger positions. But then I looked at what's going on in Latin America in terms of competition, and, you know, C Limited going in there, and e-commerce is not really the big growth segment for Mercado Libre now. It's payments and fintech, and competition is increasing, as you know, in Latin America. And if you look at, you know, the forward estimates, which I pay close attention to for revenue growth for this company, analysts are expecting revenue growth to come down below 30% year over year in a couple of years. And for me, that is usually at the time when I exit, because I don't want to be holding the bag when the revenue growth goes from 70 or 80% to 30 or 40% and then down to under 30% in 2 years from now, because that's when these growth companies get absolutely clobbered. And for me as an investor, you know, I try and get in early in these companies, early on in the S-curve, early on in the cycle, so I can, you know, pretty much relax for the next 4 or 5 years and just, you know, enjoy the effects of compounding. And I think Mercado Libre has become a mature business now. You know, their run rate is pretty large already, the revenue run rate, and it may still well do well, but I think it's not going to grow at over 30% 3-4 years out, which is why I sold out and moved on to new holdings, because new, as I said, is likely to compound at 30-40% plus over the next 4 to 5 years.
Yeah, you mentioned.
I don't dislike Mercado Libre. I just think, you know, it's matured already and it's not really suitable for my type of investing, because I try and invest in the really high growth space.
Sure. And you mentioned competition, right? Shopee, we are setting up shop in Brazil. C Limited, I believe, based in Singapore, if I'm not incorrect, Southeast Asian company, and kind of, you know, we're trying to geographically expand its e-commerce presence. Puru, I know that you're in Hong Kong. That's why it's dark out here in Houston, but it's very nice and bright in the morning for you over there. Can you tell me a little bit about Southeast Asia right now? I know that there were very kind of restrictions for COVID, and that shut down a lot of the economy in several countries. But how are things over there? Is it different than kind of the perspective we have for the economy in the United States? And then also, are there any Southeast Asian companies, tech companies, or any companies that you're kind of interested in right now?
Well, we've had the toughest COVID restrictions in the world in Southeast Asia. I mean, Hong Kong has been especially hard because Hong Kong has been following China's COVID zero policy. And, which means that we've had some really strict travel restrictions, quarantine, 1-week quarantine for all returning residents and tourists into Hong Kong. This was 3 weeks, several months ago, so it's coming down, but COVID is still impacting, the rules are impacting the way of life here. China has been pursuing the zero COVID policy, and their economy has basically slowed down significantly because of that. And because the vaccination rates have been pretty slow in this part of the world, that's why I think the Asian countries have been pretty slow to reopen. And I think, the reopening will happen perhaps towards the end of this year, early next year, but it's been quite difficult and challenging for residents in Hong Kong, because most people haven't been able to travel and leave this small city in 2.5 years now, and there's a lot of uproar against the government's policy of being so strict against COVID. But the government is doing whatever it needs to do, and hopefully things are now on the way up, and things are going to gradually reopen. Coming back to the second part of your question, Sea Limited was a pretty interesting business. And I've also been watching Grab, which is the ride-hailing business from Singapore also, which looks pretty decent. But again, I'm not really sure at this moment about their profitability and margin profile. So I'm just watching it from the sidelines. Apart from that, all my other investments right now are either in the US or Latin America or Europe. I don't really have any direct exposure to Asian companies at this point in time.
And how about investors in Southeast Asia? You've got a lot of purchasing power out in that region of the world right now. People are buying more stocks, are getting more interested in investing. Is it kind of a Silicon Valley, go after the tech companies that they're interested in? Do they like dividends? How do investors think about the stock market in Southeast Asia?
I think it depends, Simon, like anywhere else in the world. The older generation wants the blue chips, with dividends and income and stuff like that. Some investors prefer, the innovation, the growth side of things. So it's pretty much, a pretty individual choice. It's not really one sort of brush stroke for everybody. It comes down to what people are looking for in terms of their investments and where they are in their life cycle.
Just two more questions for you, Puru. I'm really thankful for your time here today. But my first one of those is position sizing, right? You mentioned earlier diversification is 15 to 20 companies. After that, it's diversification, because you're just, getting rid of your returns. But what's a large position size for you? How long will you let a company run before you pull it back in again?
Normally, Simon, for a high conviction company, I may, invest 6-7% at the outset. But if the position keeps increasing and everything is fine, I don't necessarily trim it, unless we have like a crazy mania like we did in 2020-21, where stocks were going up 4x, 5x, 6x in a year. That has never ever been sustainable in the history of investing. That was a clear bubble, and that's why I was selling out my shares when they were doubling, tripling, and getting out. And a lot of people on Twitter were saying, "Oh, he's not an investor; he's a trader." Well, it's not really a question of being an investor or a trader. If someone's going to give me years of returns on a platter in 3 months, I'm not going to, sit by and say, "Oh, actually, I'm not going to take my profits because I'm an investor and not a trader." And, all of those companies are now down 70 or 80%. So if the business is, doing well, and if we don't have any sort of excesses or mania in the stock market where the valuations have become so unhinged from the business reality, I don't usually trim my positions at all. It's only when the excesses become so obvious to me and glaringly obvious, where I know the future returns are going to be poor and there's not much upside left from these companies. In those cases, I may actually get out completely or trim my position by 40-50%. But those instances are rare, because stocks generally don't go up 4-5x in 1 year.
Very true. And my last one, Puru, is about hedging. This is something that I consider you to be very, very skilled at. I know a lot of people ask you about this all the time. It's very complex. I don't think anybody could do it as well as you do, but for anyone that does want to kind of minimize downside, certainly right now, that's a topic, is hedging downside risk in a bear market. Are there any practical words of advice you could give for investors on how to hedge that isn't extremely complex, as I know that you are typically doing?
It's not very difficult, Simon. All you need to do is, find an ETF or index futures, which pretty much correlate with the holdings in your portfolio. So for an investor who's invested in the high growth innovation space, they may sell short ARK ETF, which is basically similar in its composition, which is what I do. So if I want to hedge my exposure, long exposure, I sell short ARKK, which is the equivalent. So if I'm long, say $100 worth of shares, I will sell short $100 of ARK. So if the market goes down, my portfolio goes down 5%, so 100 becomes 95. My short also goes down, but I'm short the ARK, so I'm making money. So it basically keeps me pretty much even. You know, it's not a perfect hedge, but it keeps me pretty stable during unfavorable market conditions. And I'm not always hedged. I hedge only during downtrends, not during uptrends. So when ARKK is trending higher, then I don't hedge my portfolio at all. When ARKK is trending lower, that's when I sell short ARK and hedge my portfolio. So in other instances, I may also sell short Nasdaq index futures if I'm particularly negative about the near-term outlook. But anybody can do this. You know, it doesn't require a degree in engineering or anything like that. All you need to do is look at moving averages. You can look at any medium-term moving average, so a 50-day or a 70-day or a 100-day, 150-day. And if you want to keep things really simple, you can basically sell short your corresponding ETF, which is highly correlated to your holdings. When the ETF or the futures go below that moving average, and then when the ETF goes back above that moving average, you get rid of the hedge. So as long as price is trending below the moving average of your choice, you are hedged. And when the price goes above the moving average, which means the uptrend has resumed, you buy back the ETF or the index that you actually sold short, and then you are exposed to market risk. You're taking on market risk. So by hedging, all I'm trying to do is during downtrends, when the path of least resistance is downwards, I am trying to basically get myself out of the market by being market neutral. And by removing the hedge when the ETF goes above the moving average, I am trying to participate in the uptrend, which is what every investor is trying to do at the end of the day. You know, try and minimize the downside and maximize the upside. So I mean, hedging has worked pretty well for me in this downturn. It hasn't done amazingly well, but if the typical drawdown in the investor's portfolio this year in the growth space is maybe 40-50%, my portfolio is down perhaps 15%, 1.5. So it hasn't been a perfect hedge, but it's done its job, as well as one would have hoped. And that's why I hedge. I mean, I don't do it because I like the complication. I just do it because it just allows me to sleep well when the market is trending lower, whatever the reason might be, whether it's the Fed, whether it's a war or pandemic, it doesn't really matter. Whenever the price, goes below the moving average, I hedge and I remove the hedge. So it's, purely objective. It's not, subjective or based on my opinion or anything like that. I just follow price and the trends in the market to hedge or not hedge. It's as simple as that. It's not complicated.
But it's objective and it's methodical. I think you've done it very well, Puru. We chatted about quite a bit here today. We're kind of winding down. We talked about interest rates. We talked about inflation. We talked about growth style investing. We talked about Latin America. We talked about hedging. I guess to sum all of this up together, do you have any kind of thoughts for investors that might be watching this podcast or listening to this podcast? What's on the horizon for 2022? It sounds like we've got some challenges. We've certainly got the American economy has got some things to keep itself busy this year. But any words of wisdom for investors and what to expect for the upcoming year here?
My assessment is that the bulk of the carnage, Simon, in the high growth space is now behind us. And even in the indices, I suspect we may go down another 10-12% or so, but I don't think we're going to see a 50% bear market in the indices like we saw in 2000, 2002, and also in the global financial crisis in 08, 09. I don't think that's on the cards. I mean, I may be wrong. Things can change pretty quickly if there's a policy error. But the way things are right now, I think, we may see a little bit more selling in the indices. Growth stocks, in my opinion, have pretty much, done their thing. They've already corrected all the excesses and then some. So valuations have become much more reasonable today. And over the next few weeks, or maybe in the next couple of months, as the economy slows down pretty rapidly and inflation cools, I believe we are going to see a pause from the Federal Reserve. And as soon as the Fed says, right, we are pausing now, we're going to take a wait and see approach, risk assets are going to take off. So I think the second half of this year is likely to be a lot better than the first half. And as soon as we have a policy pause or a policy shift from the Fed, I think these beaten down long duration risk assets are going to really take off over the next 12 to 15 months or so. So I think if you are a shareholder in these high growth tech stocks, which have been absolutely pummeled over the last few months, I think the risk reward today is a lot more favorable than it was late last year, because prices were 3 times higher. In the investment business, your risk is directly proportional to the price. The lower the price, the lower the risk, and vice versa. The higher multiples, especially when you get to a 30, 40, 50 times revenue sort of range, have historically never ended well. And today, you can buy into these same companies, Simon, at 10, 12 times year-end revenue, 7 or 8. In some cases, Twilio is trading in single digits, 2022 revenue multiple, which is absurd. Okta is down. And even, the other growth stocks in my portfolio, the really high growth promising companies like SentinelOne, GitLab, Confluent, all these companies are now trading at what I consider reasonable valuations. So I think, as a shareholder, I'm hoping that over the next 4 or 5 years, I will be able to capture all, if not, most, if not all the business growth from these companies, because I don't really think that there's going to be much more valuation compression in the next 3 or 4 years. But I may be wrong, we'll see.
That's a perfect summary of where we stand in the U.S. economy and the stock market right now. Again, Puru Saxena is a individual investor, a retired money manager. It's really a pleasure having you on the podcast here today, Puru. Thanks very much for joining us.
Thank you very much, Simon. Always a pleasure to talk to you.
Thanks, everybody, for tuning in to this edition of our 7 Investing podcast. We are here to empower you to invest in your future. We are 7 Investing.